All right, Andrew John here, and I need you to lock in for the next few minutes. What I'm about to share with you is not speculation, it's not theory, and it's not another recycled headline from the financial media. This is about a structural breaking point in the American consumer economy that is happening right now in real time. Credit card debt in the United States has just crossed $1.17 trillion. That is not a typo. $1.17 trillion in revolving consumer debt, the highest nominal level in the history of this country. But here's what makes this different from every other debt milestone we've crossed. The delinquency rate, the percentage of borrowers who are 90 days or more past due, has spiked to 3.8%, the highest level since 2011, and it's accelerating. We are not in a recovery. We are not in a soft landing. We are in the early stages of a consumer-led credit crisis that will ripple through the banking system, the retail sector, and the broader economy with a force that most investors are completely unprepared for. The mechanism is already in motion. The defaults are piling up. The banks are tightening lending standards. And the consumer, the engine that drives 70% of U.S. economic activity, is tapped out. In the next 25 minutes, I'm going to walk you through exactly how we got here, why this is different from 2008, and most critically, the three asymmetric plays that will allow you to not just protect your wealth, but position yourself to capitalize on the dislocation that's coming. This is not about timing the crash. This is about understanding the inevitable consequence of a system built on unsustainable debt and positioning yourself accordingly. So turn off the distractions, lock in, and let's break this down step by step, because what I'm about to show you is a wealth preservation framework that will separate you from 99% of investors who are still operating under the illusion that everything is fine. Before we dive into the current data, you need to understand the foundational framework that governs every debt crisis in history. I call this the debt saturation threshold, and it's a concept that explains why consumer debt doesn't just grow indefinitely, but reaches a breaking point where the system can no longer sustain the burden. Here's how it works. In a healthy economy, consumers borrow to smooth consumption over time. They take on a mortgage to buy a house, they finance a car, they use credit cards for convenience and emergencies, and they pay down that debt out of their income. The system works as long as income growth keeps pace with debt growth. But when debt grows faster than income for an extended period, you hit a saturation point. Consumers are spending more and more of their income just servicing existing debt, which leaves less money for new consumption. At a certain threshold, they can no longer take on additional debt, even if lenders are willing to extend it because they physically cannot make the payments. And that's when defaults begin to spike. We are at that threshold right now. The average American household is carrying over $17,000 in credit card debt. The average interest rate on that debt, thanks to the Federal Reserve's rate hikes, is now over 22%. That means if you're making minimum payments, you're paying nearly $4,000 per year just in interest alone, not paying down principal, just interest. And here's the brutal reality. Median household income in the United States has barely grown in real terms over the last 2 decades when adjusted for inflation, but the cost of essentials, housing, food, energy, healthcare has exploded. What that means is that the average American has been using credit cards not for discretionary spending or lifestyle upgrades, but to bridge the gap between stagnant wages and rising costs. They've been borrowing to survive, and now the bill is coming due. The core thesis of this video is straightforward but profound. We are witnessing the beginning of a consumer credit collapse driven by unsustainable debt levels, punishingly high interest rates, and an economy that has exhausted its ability to generate real income growth. This collapse will create a cascade of defaults, bank losses, and economic contraction. But for those who understand the mechanics and position accordingly, it will also create asymmetric opportunities in distressed credit, inflation hedges, and systemic protection assets. The playbook is already written in history. We've seen this before in the Great Depression, in the stagflation of the 1970s, and in the subprime crisis of 2008. The only question is whether you're going to recognize the pattern in time to act on it. Now let's turn to history, because if you don't understand how debt crises unfold, you're going to be blindsided by what's coming. The first parallel we need to examine is the Great Depression, and specifically the credit contraction of 1930 to 1933. Most people remember the stock market crash of 1929, but that was just the opening act. The real wealth destruction came in the years that followed when the credit system seized up. During the roaring 1920s, American consumers went on a borrowing binge. They bought cars on installment plans, they purchased appliances and furniture on credit, and they speculated in the stock market using borrowed money. Total consumer debt more than doubled during the decade. Banks were happy to lend because asset prices were rising and defaults were low. Everyone believed the boom would continue forever. But when the stock market crashed and unemployment started to rise, consumers couldn't service their debts anymore. Defaults exploded. Banks that had extended all this consumer credit started taking massive losses. Over 9,000 banks failed between 1930 and 1933, wiping out the savings of millions of Americans. The credit system collapsed, and the economy entered a deflationary spiral that lasted a decade. Here's the critical lesson from the Great Depression. The people who preserved their wealth were not the ones who stayed in the system hoping for a recovery. They were the ones who moved into hard assets before the collapse fully materialized. After 1933, when Roosevelt took the U.S. off the gold standard and devalued the dollar by confiscating gold and revaluing it from $20.67 to $35 per ounce, those who had held physical gold saw their purchasing power increase by 69% overnight, while everyone else holding dollars and bank deposits watched their wealth evaporate. The second historical parallel, and this one is even more relevant to today, is the credit card crisis of the early 1990s. This is a chapter of financial history that most people have completely forgotten, but it's a perfect template for understanding what's about to happen. In the late 1980s, credit card companies went on a massive issuance spree. They mailed pre-approved cards to anyone with a pulse, credit limits were raised aggressively, and consumers, still riding the high of the Reagan boom, borrowed heavily. But when the savings and loan crisis hit in 1990 and the economy tipped into recession, credit card defaults spiked. Charge-off rates, the percentage of debt that banks had to write off as uncollectible, hit 6.5% by 1991. To put that in perspective, a 6% charge-off rate means that for every $100 billion in credit card debt, $6 billion is never getting repaid. The banks took massive losses and they responded by dramatically tightening lending standards, which made the recession worse because consumer spending collapsed. But here's what's different today and why this crisis is going to be more severe. In the early 1990s, total consumer debt was a fraction of what it is now. The economy was still relatively healthy outside of the recession, and most importantly, interest rates were much lower, which meant the Federal Reserve had room to cut rates aggressively to stimulate borrowing and spending. Today, we have none of those cushions. Consumer debt is at all-time highs in nominal terms and near all-time highs as a percentage of disposable income. The economy is already showing signs of stress with GDP growth slowing, unemployment ticking up, and corporate earnings under pressure. And the Federal Reserve, even after recent rate cuts, is still holding rates at levels that make consumer debt servicing extremely painful. There is no policy bailout coming this time. The Fed cannot cut rates to zero again without destroying the dollar's credibility and reigniting inflation. They are trapped, and so are consumers. The third historical case we need to look at is 2008, but not the housing crisis itself. What I want you to focus on is what happened to consumer credit in the aftermath. During the financial crisis, credit card charge-offs peaked at just over 10%. That means 1 out of every $10 lent on credit cards was never repaid. The losses were staggering. Banks like Citigroup and Bank of America had to write off tens of billions of dollars in consumer credit losses. But here's what's critical. In 2008, consumers still had equity in other assets. Many had home equity even after the crash. They had 401k balances. They had savings. They could tap those resources to keep making credit card payments or to negotiate settlements. Today, consumers have far less equity cushion. Home equity has been extracted through refinancing and home equity lines of credit. Retirement accounts were depleted during the pandemic. Savings rates are at multi-decade lows. When this crisis hits, consumers will have nowhere to turn. The safety nets are gone. Now let's talk about what's happening right now because the data is absolutely screaming that we are in the early stages of a credit crisis. As of the fourth quarter of 2025, total credit card debt in the United States stands at $117 trillion. That's up from $986 billion just 2 years ago, a 19% increase in 24 months. But the nominal number is only part of the story. What matters more is the quality of that debt and the ability of borrowers to service it. And on both of those metrics, the situation is deteriorating rapidly. The delinquency rate on credit card debt, defined as accounts that are 90 days or more past due, has jumped to 3.8%. That is the highest level since 2011, right after the financial crisis. And the trajectory is what should alarm you. Delinquencies have been rising steadily for the last 8 quarters. This is not a blip. This is a trend, and it's accelerating. Now, you might be thinking 3.8% doesn't sound that bad. But here's what you need to understand. Banks don't report a loan as delinquent the moment someone misses a payment. There's a lag. By the time a loan shows up in the 90-day delinquent category, the borrower has already missed 3 full payment cycles. They are deep in distress, and historically, once a loan hits 90 days delinquent, the probability of it ever being repaid drops below 20%. That means that of the $1.17 trillion in outstanding credit card debt, roughly $44 billion is already in severe distress. And that number is going to grow exponentially over the next 12 to 18 months. But it gets worse. The charge-off rate, which measures the debt that banks have officially written off as uncollectible, is now at 4.7% and rising. That means nearly $55 billion in credit card debt has been written off in the last 12 months alone. To put that in context, during the 2008 financial crisis, credit card charge-offs peaked at around 10%. We're not at that level yet, but we're on the same trajectory. And here's the key difference. In 2008, the crisis was triggered by subprime mortgages, and it took months for the contagion to spread to other parts of the credit system. This time, we're starting with the consumer already tapped out. The contagion is going to move faster. Now let's talk about the mechanism that makes this a systemic problem, not just a consumer problem. The banks that issue these credit cards, the JP Morgans, the Bank of Americas, the Citigroups, they don't just hold the debt on their balance sheets and hope people pay it back. They securitize it, they bundle millions of credit card accounts into asset-backed securities, and they sell those securities to pension funds, insurance companies, and other institutional investors. This is the exact same structure that blew up the housing market in 2008, just with credit cards instead of mortgages. When charge-offs spike, the value of these securities collapses. The institutions that own them take losses, and the banks that issued the cards have to absorb the hit to their balance sheets. This creates a feedback loop. As losses mount, banks tighten lending standards. They cut credit limits, they stop issuing new cards, and they raise interest rates on existing balances. That makes it even harder for consumers to access credit, which accelerates defaults, which creates more losses for the banks. It's a deflationary debt spiral. And once it starts, it's almost impossible to stop without massive government intervention. But here's why government intervention is not going to work this time. The political will to bail out big banks again simply does not exist. After 2008, the public was outraged that taxpayers had to rescue Wall Street while Main Street suffered. Politicians know that another direct bailout would be political suicide. Instead, what we're going to see is something much more insidious: financial repression. Let me explain what that means, because this is the quiet mechanism that's already being deployed. Financial repression is a policy framework where governments and central banks deliberately keep interest rates below the rate of inflation. This creates negative real interest rates, which means that savers lose purchasing power over time while the government inflates away the real value of its debt. It's a stealth tax. It's a wealth transfer from creditors to debtors, from savers to borrowers, and from the private sector to the state. Right now, even after the Federal Reserve's rate hikes, real interest rates are barely positive. If you're holding cash in a savings account earning 3%, but inflation is running at 3.5%, you're losing purchasing power. And that's assuming the official inflation numbers are accurate, which they're not. If you use the methodology from the 1980s to calculate inflation, real inflation is closer to 7 or 8%. That means real interest rates are deeply negative. Your wealth is being silently taxed at 4 to 5% per year. This is not an accident. This is deliberate policy. And it's going to accelerate as the consumer credit crisis deepens, because the government has no other option. They cannot allow deflation. They cannot allow mass defaults to collapse the banking system. So they will print money, they will keep rates suppressed, and they will inflate the debt away. The problem is that destroys the currency. And that's why the asymmetric play in this environment is to move your wealth out of the financial system and into assets that cannot be debased. Now let's connect this to the broader economic picture, because the consumer credit crisis doesn't exist in isolation. It's part of a larger debt supercycle that's reaching its terminal phase. According to the Bank for International Settlements, global debt has now exceeded $315 trillion. That's government debt, corporate debt, and household debt combined. And it represents over 330% of global GDP. To put that in perspective, at the peak of World War II, when the United States was financing the largest military mobilization in history, debt to GDP was around 120%. We are now at levels that are unprecedented outside of wartime, and there is no clear path to bringing that debt down without either default, inflation, or financial repression. The United States federal government alone is carrying over $36 trillion in debt, and the interest payments on that debt now exceed $1 trillion per year. That's more than the defense budget. That's more than we spend on Medicare. And it's growing exponentially because as old debt matures, it has to be refinanced at much higher interest rates. This creates what economists call a debt trap. The government has to borrow more money just to pay the interest on existing debt, which increases the total debt burden, which increases future interest payments, which requires even more borrowing. It's a vicious cycle, and the only way out is to devalue the currency through inflation. The Federal Reserve knows this, the Treasury knows this, and they are actively preparing for it. That's why they've been issuing more short-term debt instead of long-term debt, because they know that long-term rates are going to spike as investors demand higher yields to compensate for inflation risk. That's why they've been coordinating with other central banks to manage currency volatility and prevent a disorderly sell-off in treasuries. And that's why they're quietly encouraging banks to tighten consumer lending standards now before the crisis gets out of control. They're trying to engineer a controlled deleveraging, but the problem is there's no such thing as a controlled deleveraging when debt levels are this high. Once the defaults start, they feed on themselves. Now let's talk about the three asymmetric plays that will protect you and position you to profit from this crisis. The first play is distressed consumer credit and deep value financials. When the charge-offs spike and banks are forced to write down massive losses, their stock prices are going to get crushed. But not all banks are created equal. There are regional banks and credit card issuers with strong balance sheets, conservative underwriting, and low exposure to subprime borrowers that are going to get thrown out with the bathwater. These are the institutions that will survive the crisis and come out stronger on the other side. The asymmetric opportunity is to buy their equity and their debt at distressed prices and hold through the cycle. Historically, this is how fortunes are made. In 2008 and 2009, investors who bought bank stocks at the bottom and held them through the recovery saw 10-to-1 returns or better. The key is to focus on quality, on institutions with fortress balance sheets, and the liquidity to weather the storm. This is not a trade for the faint of heart, but the risk-reward is extraordinary. You're looking for banks with Tier 1 capital ratios above 12%, non-performing loan ratios below 1%, and diversified revenue streams that aren't overly dependent on consumer credit. These banks exist, and they're going to be available at fire sale prices when the panic hits. The second play is inflation hedges, specifically precious metals and commodity producers. If the government's response to the credit crisis is financial repression and money printing, and it will be, then the assets that benefit most are the ones with intrinsic value that cannot be inflated away. Gold and silver are the obvious plays here. Gold is already breaking out to new all-time highs as central banks around the world accelerate their purchases. China, Russia, India, and the Middle Eastern sovereign funds are all buying gold at record pace because they understand that the dollar's reserve status is being eroded by reckless monetary policy. According to the World Gold Council, central bank purchases in 2025 exceeded 1,000 tons for the third consecutive year. This is not portfolio diversification. This is a coordinated move away from dollar-denominated assets and into hard money. When the consumer credit crisis forces the Federal Reserve to pivot back to quantitative easing, and it will, gold is going to go parabolic. We're talking about a move from current levels around $2,700 per ounce to $4,000, $5,000, or even higher. The technical setup is there, the fundamental drivers are there, and the geopolitical backdrop is there. Silver, which is trading around $32 per ounce, has even more asymmetric upside because of its dual role as both a monetary metal and an industrial commodity. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is currently around 84-to-1. The historical average is closer to 60-to-1. When that ratio reverts, silver will outperform gold on a percentage basis by a wide margin. And the mining companies that produce these metals, the high-quality senior producers with Tier 1 assets and strong balance sheets, are going to be the leverage play. A doubling of the gold price typically translates to a tripling or quadrupling of the stock price for well-run miners. This is where asymmetric returns are generated. You're looking at companies like Newmont, Barrick Gold, Wheaton Precious Metals, and Franco-Nevada. These are not speculative junior explorers. These are established producers with proven reserves, low-cost structures, and the ability to generate massive free cash flow when metal prices rise. The third play, and this is the systemic hedge that everyone needs to understand, is physical precious metals held outside the banking system. Not ETFs, not paper claims, not unallocated storage. I'm talking about physical gold and silver coins and bars that you own outright and store in your possession or in a fully allocated, segregated vault. The reason this is critical is because when the credit crisis escalates and banks start failing or implementing capital controls, you need to have wealth that exists entirely outside the system. Physical precious metals are the only asset class that has zero counterparty risk. There is no bank, no broker, no institution standing between you and your wealth, its final settlement. And in a crisis, that's everything. During the bank runs of the Great Depression, people who had physical gold were able to preserve their purchasing power, while those who had bank deposits lost everything. During the currency crises of the 1970s, physical gold holders saw their wealth multiply while those holding cash and bonds got destroyed. The pattern repeats every single time, and it's going to repeat again. Now let's talk about the specific signals that tell us this crisis is accelerating right now. First, consumer savings rates have collapsed. The personal savings rate in the United States, which spiked to over 30% during the pandemic stimulus era, has now fallen to just 4.1%, the lowest level in over a decade. That means consumers have burned through all the excess savings they accumulated during COVID, and they're now spending more than they earn. They're going into debt to maintain their lifestyle. Second, real wages are declining. When you adjust nominal wage growth for inflation, real wages have been negative for the majority of the last 3 years. Workers are making more dollars, but those dollars buy less, and that gap is being filled with credit card debt. The Bureau of Labor Statistics data shows that real average hourly earnings have declined by approximately 2% since early 2023. That might not sound like much, but compounded over time, it represents a significant erosion of purchasing power. Third, retail sales are weakening. Despite all the headlines about a strong consumer, when you dig into the data, retail sales growth is slowing. And when you adjust for inflation, real retail sales are flat or declining in key categories. Department stores are seeing declining traffic. Discount retailers are reporting weaker margins. And luxury goods, which held up well during the pandemic, are starting to soften. Consumers are cutting back, and the retailers are starting to feel it. Fourth, buy now, pay later services are exploding. Consumers who can't qualify for traditional credit cards or who have maxed out their existing cards are turning to buy now, pay later platforms like Affirm, Klarna, and Afterpay to finance even basic purchases. Total buy, now pay later transaction volume in the United States exceeded $80 billion in 2025, up from less than $30 billion in 2021. This is subprime lending dressed up in a tech wrapper, and the delinquency rates on these loans are starting to spike, just like traditional credit cards. These platforms report to credit bureaus, and when consumers default, it tanks their credit scores, which makes it even harder for them to access traditional credit in the future. Fifth, and this is the big one, banks are tightening lending standards across the board. According to the Federal Reserve's Senior Loan Officer Opinion Survey, banks reported a significant tightening of lending standards for consumer loans in the fourth quarter of 2025. That means they're cutting credit limits, denying applications, and raising interest rates on existing balances. This is not what banks do in a healthy economy. This is what they do when they see defaults coming and they're trying to reduce their exposure. The net percentage of banks tightening standards reached levels not seen since 2008. When you see this kind of coordinated tightening across the banking system, it's a leading indicator that credit stress is about to spike. All of these signals point to the same conclusion. The consumer is tapped out, the credit cycle is turned, and the defaults are about to accelerate. Now let's talk about what you need to do right now, because understanding the problem is only half the battle. The action checklist is straightforward, but it requires discipline and urgency. First, you need to assess your own debt situation. If you're carrying high-interest credit card debt, that is a financial emergency. You need to pay it down as aggressively as possible, or transfer it to a lower-rate loan if you can qualify. The absolute worst position to be in right now is carrying revolving debt at 22% interest when your income is stagnant or declining. Every dollar you pay in interest is a dollar that could have been moved into productive assets or emergency reserves. Second, you need to build an emergency fund if you don't already have one. In a credit crisis, access to cash becomes critical. Banks tighten lending, credit lines get cut, and if you lose your job or face an unexpected expense, you need liquid reserves. I recommend a minimum of 6 months of living expenses in cash or cash equivalents, and if you're in a high-risk industry or you see warning signs in your job, push that to 12 months. This is not about earning a return. This is about survival capital. Third, you need to establish a position in physical precious metals. If you don't already own gold and silver, start now. I recommend a minimum allocation of 10 to 15% of your investable assets. This is not a speculation. This is insurance against systemic risk and currency debasement. You want to buy physical coins and bars from reputable dealers, and you want to store them securely outside the banking system. Avoid ETFs and paper gold products because those are still claims on the financial system. In a crisis, you want the metal in your hand or in a vault that you control directly. Fourth, you need to reduce your exposure to financial sector equities unless you're specifically positioning in the deep value distressed opportunities I mentioned earlier. The average investor who owns bank stocks through index funds or mutual funds is going to take significant losses when the credit crisis hits. If you're going to own financials, you need to be selective, focusing on the strongest institutions with the best balance sheets. Fifth, you need to diversify your income streams. If you're reliant on a single job or a single source of income, you are taking on concentration risk that you don't need to take. In a consumer-led recession, layoffs accelerate, and if you're not prepared, you could find yourself in a very difficult position. Look for ways to generate side income, whether that's freelance work, a small business, or passive income from investments. The goal is to create redundancy so that if one income stream is disrupted, you have others to fall back on. Sixth, stay informed and stay flexible. The macro environment is evolving rapidly, the data is changing week by week, and the policies that governments and central banks implement in response to the crisis will create both risks and opportunities. You need to be monitoring the situation closely and be ready to adjust your positioning as new information emerges. This is not a set-it-and-forget-it environment. This is a moment that requires active engagement. Follow the Federal Reserve's statements, track the credit market data, watch what the smart money is doing, not what they're saying. Now here's the question I want you to answer in the comments, and I genuinely want to hear your perspective on this. Do you believe the consumer credit crisis is going to be worse than 2008, or do you think the system has enough cushions in place to avoid a full-scale meltdown? I'm seeing arguments on both sides from very smart analysts. Some believe that because consumers have more equity in their homes than they did in 2008, and because unemployment is still relatively low, the system can absorb the credit card defaults without a broader collapse. Others, and I'm increasingly in this camp, believe that the debt levels are so much higher now, the consumer is so much more leveraged, and the policy tools are so much more limited that this crisis is going to be worse. The fact that we're starting from a position of much higher total debt, much lower savings rates, and a Federal Reserve that has already exhausted most of its conventional policy tools suggests that the downturn could be deeper and longer than 2008. I want to know where you stand. Drop your answer in the comments. Let's get a real debate going because the diversity of perspectives in this community is one of its greatest strengths. And if you found value in this breakdown, if you understand that what we just covered is information you will not get from mainstream financial media, then I need you to do two things right now. First, hit that subscribe button and turn on notifications. This channel is dedicated to cutting through the noise, connecting the dots that others won't connect, and giving you actionable intelligence that you can use to protect and grow your wealth. We're not here to sell you hopium or tell you everything is going to be fine. We're here to look at the data objectively, understand the historical patterns, and position accordingly. Second, share this video with anyone you know who is carrying credit card debt or who is invested in the financial sector. They need to understand what's coming. The consumer credit collapse is not a maybe, it's a when. The math is undeniable. The delinquencies are rising, the charge-offs are accelerating, and the banks are preparing for the worst. The decisions you make in the next few months are going to determine whether you preserve your wealth or watch it get swept away in the crisis. The data is clear, the mechanism is in motion, and the asymmetric opportunities are right in front of us. The only question is whether you're going to act while you still have time or whether you're going to wait until it's too late. This is not fear-mongering. This is pattern recognition. This is understanding that every debt supercycle ends the same way, with defaults, deleveraging, and a massive wealth transfer from those who didn't prepare to those who did. Stay sharp, stay prepared, and I'll see you in the next one.